Right, welcome to REI 101. Appreciate you, everyone who's jumping on the call today. We got a special guest with us, Mr. Magdiel Garza. Magdiel, how are you doing today, sir?
I am good. Can you guys hear me okay?
Loud and clear. So this is
All
Magdiel,
right.
one of a very important person in the industry. So we spoke a few weeks ago with hard money. Now we're going to talk about commercial lending, and today we want to get into multifamily asset types. Maybe talk a little bit about some other asset types as well. But we get a lot of questions. A lot of people flipping single family homes, a lot of people buying single family homes, and um, the natural progression from single family is into multifamily. So we want to get into that today. We're going to analyze some deals and talk about, you know, what it takes to get into the asset type, what it takes to evaluate, and most importantly, what does it take to make money with this strategy. So let's talk about money, Magdiel. Tell us a little bit about yourself, who you are, and why we need you in our life.
Well, thank you, Austin. So, my name is Magdiel Garza. I am a commercial lender here at SouthTrust Bank here in Houston. We're a smaller, kind of a boutique bank here in the city center area on the west side of town. What we do primarily, we focus on real estate, everything real estate when it comes to whether multifamily, retail centers, portfolio investment homes, things like that. So we're able to kind of really land on anything from cashing out of one of those if you
Hmm.
have some equity in it, everything to purchasing, and even in some cases building new duplexes or multifamilies, things like that. So that's what we do. Typically, we're in it, we do prefer the Houston and surrounding footprint. So Houston, Galveston, Woodlands, all that good stuff. And usually we're looking for anything 5, 6 million and below in loan size.
Okay. Okay.
Mhm.
So what would you say
Yeah.
is like the top three asset types that you're lending on right now?
Asset types, really anything real estate. So right now, just as an example, in my pipeline, I've got a church that is
Hmm.
refinancing a building. I do have a shopping center. It's actually a single tenant shopping center, but it is a shopping center. And then I've got a smaller apartment complex that I'm looking at that someone is purchasing. And so, really, the other thing is I've got an investor who's got about five rental homes, all free
Hmm.
and clear, and he's wanting to, instead of using hard things like that, he's wanting to just lump them together and get a kind of a portfolio loan, if you will.
Yeah.
And we can typically give them about 65% of the total value of the portfolio,
So
and they
when
can do with it what they wish.
can you expand a little bit on the portfolio loan? So at what point would someone need to roll their portfolio over into a loan? Or is that only in the case when somebody's purchasing a portfolio? Because if we're building a portfolio, what would be the pros and cons to rolling that into a portfolio loan? Can you talk a little bit about that?
Yeah. So, obviously, if right now you're using your own money, your own cash, and you're sort of finding yourself in a situation where you've kind of used all your cash to go out and buy the next flip or long-term hold, you can actually use some of the equity that you've already got existing. Or if, you've got, let's say, three homes that are paid off and the other two are just kind of
Hmm.
lingering out there with smaller mortgages, you can just lump them all together, have one note and not worry about which one has equity, which one doesn't. Um, and that just a lot of times replaces kind of a hard money, or sometimes we can even do a line of credit on the portfolio, so we can do you're really not paying on it until you're using it. So
Okay.
that's also a pretty popular product as well. And
Does it
again,
get,
we can do up to 65% of the value.
okay.
Mhm.
Does it get complicated if somebody needs to sell, if they're holding the portfolio in the loan, they need to sell some of the assets in the portfolio, or how does that work?
It's not a complicated issue, but it is, obviously we want to make sure that we're still in a good collateral position. So we would want, after that asset is sold off, we'd still want to make sure that we're in the 65%. We can't exceed that 65% loan to value. And
Hmm.
so, you know, we would just have to kind of make sure that that's the case. Or we could also adjust the line of credit. If it is a line of credit, we can adjust the line amount to make sure it coincides with that. I'm not sure if that makes sense, but
Okay. Yeah, that makes
essentially
sense.
that's one way of doing it. And we do
Okay.
all that in house, so we would explain and work with the client with that.
So today, what we want to talk about is getting into more of a multifamily. And just to clarify, we're going to add some words to the word wall. There's some terms and some abbreviations that we're gonna use today. If you don't know what something means, feel free to raise your hand, come off mute, put a chat in the chat box. We're here to educate. That's the purpose of this show, and figure out what some of these terms means. And so I want to contrast financing single family home investments, whether it be a buy and hold or a fix and flip, and contrast that with multifamily. So, first, tell us when it comes to investor buying single family homes, what are the typical things, just briefly, typical requirements for an investor buying a single family home? What are we looking at?
Yeah. And so, just to preface, it's a lot of this is going to be redundant. A lot of what we need for the single family is going to be the same for multifamily, just maybe on a
Hmm.
bigger scale. But for us, anything under 500,000 in purchase price or loan size, we would only need 2 years worth of financials. And what I mean by financials typically is 2 years worth of business tax returns, 2 years worth of personal tax returns, and then a personal financial statement, which is a pretty simple one-page document that essentially just goes over all of your personal assets and liabilities. Because as you can imagine, when you send me as the bank your tax returns and things like that, that's a snapshot of what you had, let's say going back to 2024, but it doesn't
Right.
really tell me what your position is today. So the personal financial statement essentially breaks down uh, how much cash you have in the bank, your value of your home, any credit card debt, things like that. And so we go in and we kind of figure what your net worth is. And the
Right.
reason that's important is because we're wanting to make sure that after this purchase of whatever it is you're purchasing, that you're going to have some money left in the bank, essentially.
Okay.
If time's tough, if you've got some vacancies, if it's just a little slower market than we thought, you're going to be able to kind of weather that storm. So that's why we want to make sure that you have that liquidity left in the bank. So
Got
that's
it.
the importance of the personal financial statement. And then the last thing essentially is just, we're wanting to make sure the property cash flows. So we want to know as much as we can about the property.
Hmm.
So, I'll have clients send me a flyer or the HAR information, things like that. And then I take that and I make sure that we are double checking our numbers. We want to make sure that the comps are correct on what you're telling me you can rent it out for. Because essentially what we're looking to do is run a cash flow model to make sure that what you're making is going to cover the debt and a little more. And so that's what we call our debt service coverage ratio. And slow me
Got
down
it.
if I'm kind of throwing too much there,
So
Austin. But
yeah, no,
debt,
that's excellent. So one thing I heard you say is what the property could rent for. So if I have a vacant property and it's not renting out, we can still deal with that, right? That may not be the case with the
we can.
multifamily. Go ahead.
Correct. That's correct. No, you're right. We can on a property that's vacant. Um, we're going to rely a little heavier on your personal assets or your
Yeah.
personal income. Because we want to make sure that there's a secondary source of repayment. If the house stays vacant for the next 6 months, do you have enough money or are you making enough money, whether you be W-2 or you have a business, whatever that may be, whether you're making enough or not to pay that debt?
So when
yeah,
it
during
comes
that
to
time.
moving into the commercial side of it, so multifamily is classified as commercial. By
Mhm.
the way, if you're buying a duplex, triplex, or fourplex, those still fall under the same category as a single family home. It's the same contract, it's the same financing. Once you get to 5 units or more, it's a different situation. It's a different asset type, different type of financing, correct?
Um, that's correct in the real estate world. For bank purposes, though, again, we're essentially going to, like, let's say, for example, you're buying a single family home to lease out. We would ask that you buy it into your LLC or in an LLC. And if you
Hmm.
don't
Hmm.
have one, it's no problem. We can help you start one. But that's why I was mentioning we're really underwriting it the same across the board, whether it's one home or multifamily. We're still wanting it to uh, essentially cash flow, right? And
Got it.
so we're going to look for that debt service coverage ratio to be the 1.25, which I can go into um,
Okay. So we're
either
gonna
now or later.
cover, yeah, we'll cover DSCR here in a few moments. So really want to
Mhm.
make sure that that term. So I'm going to throw a couple of terms on the word wall that if you don't know these, we're going to talk about these. First of all, pro forma. That's Latin for bullshit. It's a word that it's a word that brokers throw around that means I don't know what I'm doing or I don't know what I'm talking about or it's optimistic. So I want to make sure we break that down. We want to talk about NOI, the net operating income, and we're going to look at a sample financial statement today that will break that down. Another method that can be used in the beginning, if you wanted just a quick evaluation, is a gross rent multiplier, GRM. That's a very simple preliminary way to evaluate some of these asset types. Um, you need to understand cap rate, and then finally, and I would put cash flow when we use that phrase exactly what we're talking about. Because if you can understand cash flow, I think DSCR, the debt service ratio, that's much easier to understand if you can understand cash flow. So ultimately, the goal of our call today is to have an understanding of what DSCR is so that we can go back and negotiate with sellers and even as agents we have to negotiate with our buyers because uh, sometimes their offer is pretty far off, or sometimes we have to negotiate with their seller. I had to negotiate with the seller client. I know this sounds really bad, but I had a client needing to sell an 8 unit. I had to convince him not to sell it. And it was
Hmm.
based on what we're talking about, DSCR of 1.25. I told him if we can't get anywhere close to that number, we can't sell. We're going to end up spending a lot of time and a lot of energy. And guess what? Most of these properties that are on the market right now, they're under one. They're under zero point 0.5,
Mm.
not
Yeah,
less 1.25. So
right.
let's get into that. So the first thing that I want to hit is gross rent multiplier. And this is a real simple thing. It has really nothing to do with it has really nothing to do with the performance of the property. It's basically just you just take the rental income and you ask yourself this question based on this listing, how many years is it going to take me to recoup my money? So if you buy a property for $1 million and the rental income every year is $100,000, you can come out off mute. How many years is it going to take to make that $1 million back? Just based on the gross rent. So I'm purchasing the property for $1 million. My rental income is $100,000 a year. How many years is it going to take? And I'll give an awkward moment for you just to kind of think about the math. So I'm purchasing the property for $1 million. My rental income is $100,000. How many years will it take to recoup that money just based on the rent?
Now, I'm sorry, Austin, are you asking me or are you asking the crowd?
Yeah, anybody that wants to answer. Yeah, you can jump in too, Magdiel.
Is it 10 years?
It's 10. So if I make $100,000 for 10 years, I get $1 million. So that's a gross rent multiplier of 10. 10 is probably too high. I'll probably am going to be more interested in six or under six, maybe a seven, possibly. But that's just a start point. If my gross rent multiplier is 20, I'm going to swipe right. I'm probably not even going to look at that that asset, that property, that listing for more than a couple of seconds. So that's one way that you can just really start going through um, these listings. So what I brought up here, this is a financial profit and loss. So if the gross rent multiplier looks interesting, I'm going to go to this next step. Next thing I want to know is I want to know what the cap rate is. Does anybody know what a cap rate is? If you want to come off mute, I can tell you what. You can tell me if you know what the cap rate is. So I will tell you. So what we're going to figure out, we got to figure out the net operating income. So net operating income is just your income minus your expenses. That's your net. It's the profit. By the way, your net operating income has nothing to do with financing. So this is aside from financing. So debt service is going to be a separate item on the menu. So we have a property right here. Um, what you need to evaluate NOI truly. Now you can just ask the agent, and they may tell you pro forma, but I need the actual numbers. Let's say that this property is generating $10,000 per month in income. So over the course of 12 months, it's generating $120,000 a month. Now, I pulled up our recent reports, and I believe my vacancy rate right now in multifamily, I don't know if you know this, but 2 years ago, back in 2023, vacancy rates in the Houston area were around seven, maybe close to eight. Look at where vacancy rates in the multifamily asset type right now are higher than office, industrial, and retail asset types. So maybe next month we'll evaluate some retail. Maybe we'll look at some office space or industrial space. But right now, vacancy rates. So when we're looking at pros and cons of multifamily, right now vacancy rates are kind of high. So what I'm going to do is I'm going to subtract 11.5%. Let's just say 11%. So if I take 10,000 minus 11%, that's about 8,900. 11% of 10,000 is about 1,100. So first of all, you want to have an idea of what your vacancy is going to be. So let's say our vacancy just is at 11%. That's going to be about 1,100 a year. That's a hit. That's that's not income. That's supposed to be a minus. Oop, minus 1,100. So you already need to calculate that vacancy. So concessions, bad debt, we're not going to worry about that right now. Income, you may get, $250 for laundry. Laundry usually is not something that produces significant income for a property. Laundry is more of an amenity for your tenants. Parking income, we're going to put zero for parking. Utility, some properties, you need to understand this about multifamily. Some properties, the utilities are separate. So electricity and plumbing and water and trash is, that might be separate. And sometimes it's in rubs. And this property, for instance, there's a utility reimbursement. So this is a situation where the landlord actually submetered their tenants and charged the tenants different amounts, so it could be somewhere around here. So we're going to put 16,000. So he's actually getting income from that, but he's also paying that bill. And then other random income right here. So right here, if you see in January, all that together is total income was 11,000 in January for the year, 140,000. Pretty good so far. But what what goes in must come out. So here's what you want. Remember, what you do not want to put on your expense report is debt service. We want to avoid debt service. But just to keep things simple, these are just the basic expenses that you would have at the house you live in. You got some taxes, you got insurance costs, utilities. In this case, sometimes the landlord doesn't have to pay the utilities. In this case, he is, but he's also charging utilities, so it's kind of a break even. Security. Don't forget salary, cleaning, turnover. Turnover may be $100 a unit. Really want to. You got to be careful because you'll pull these reports and these sellers selling these properties won't put anything for cleaning. So, how does that work? So now we have expenses close to 5,000 for the year, 53,000. So here's how to calculate the cap rate. I'm going to take my income, total income, which is $139,159. By the way, this is actual income. This is what happened I want to know what really happened here the last 12 months. I'm going to subtract my expenses and I have a net profit of 86,065. 86,065. That's my net profit. So I'm going to take that number. And so I know but what do I 86,000. Let's just say 86,000 so I'm going to put that right there. So how do I get cap rate? So I'm going to take my NOI and I'm going to take my sales price. So let's say, just pick a number. Magdiel, pick a number. How much do you think this property's going to sell for? Just guess.
Mm. What was the NOI?
So the NOI is 86,000.
36. I'm gonna say 7.
Okay, so 700,000. So is that a good deal or is that not a good deal? Well, we're going to look. I'm going to go back to my market report. This is from CoStar. We pay a lot of money for this data. We know the vacancy rate has been around 11 and a half. It's actually a little bit down from a year ago, believe it or not. Here's the market cap rate, 6.5. Now, cap rate, we need to be able to pay our mortgage. The cap rate may be a little bit low. I may not be comfortable at 6.5, but the way to get this cap rate is I'm going to take my NOI, which is 86,000, and I'm going to divide it by the purchase price. So divide it by 700. You said 700?
Yeah.
And I get a cap rate of 12.2%. Does that make sense how I got that? So 86 is literally 12%. I would say that's probably a good deal.
Hmm.
If my net is really 86,000, did I check my work? 86,000. If that truly is correct. Now, I'm going to send
Austin,
this over. Yes.
so question that I think a good point to ask a question here then.
Yes,
So
sir.
if we know our market cap rates, uh, like you and I were talking recently, 6 to 8, right? Somewhere in there. And you come up with something like this, a 12.
Hmm.
Uh, this is going to be a flag for us that maybe our P&L sheet is off a little, or the one
Yeah.
the one we're being given is off a little.
Yeah.
And how would we approach that then?
Okay. I love that question. So, number one, I'm not going to say anything at this point. If I'm representing the buyer or if I am the buyer at this point, I'm interested in getting under contract. And the reason I want to get under contract is because it gives me control of the situation. Now, Magdiel is going to rain on my parade here in a second because I'm going to send this financial statement over to him, and he's going to help me. Like as your agent, if I'm representing you, Richard, and I love that question. That's an important question. I'm going to poke holes in it. You're going to poke holes in it. Different people on my team are going to poke holes in it, but Magdiel's going to set it on fire. So he's going to come back over to this financial statement, and he's going to say, "Prove it." So if your insurance, for instance, you know, you can chime in, but you're going to ask for insurance statements. You're going to look at
Mhm.
maintenance costs. And the other thing that we haven't discussed yet is deferred maintenance as well. But yeah, it is a little bit of a red flag.
And we're also going to look, at the comps in the area. Is that fair market rental value? Is that fair
Hmm.
rentals
Yeah.
there? And so we're going to make sure. And yeah, I mean, that's one way we verify things as well.
So that cap
Are
rate
the
is
rents
still
inflated?
that cap rate
Hmm.
is still kind of a preliminary tactic to evaluate a property. But if it's performing at a 2 or 3 or 4 cap, it's probably not going to work. If if I get on the phone with the agent or the seller, I might let them know that, like, hey, market cap rates right now are 6.5. If it's a C class, those market cap rates are going to be like 8.5 or 9%. A classes are going to be lower, 4 or 5. So you want to know what class of apartment complex you're actually looking at here. But yeah, we're going to want to poke holes in that. Then we'll need to understand our cash flow. So let's say we're under contract for $700,000, and what we're trying to get to next is this DSCR. So what I normally like to do, and I think everybody should be able to do this. You should be able to amortize what the mortgage is going to be on this. So my income of $86,000 divided by 12 months is going to be about 71, 66, 67 a month. This is a month. This is a year. So this is what my monthly income is going to be. So now I got to figure out what my debt service is. So we find an amortization calculator. So Magiel, what are typical terms? So let's talk about financing terms on a property that's
Hmm.
700,000. So what would the
Yeah.
down payment usually be? And talk to me about interest rates and amortization.
Yeah, absolutely. So our maximum LTV that we can do is 75% loan to value.
Okay.
So we would obviously run an appraisal on the property and we could give you 75% of that. So you're looking at 25% down.
Okay.
Um, and we'll
So at
typically do a 5 year. Oh, go ahead. Mhm.
so at 700 minus 25%.
Mhm.
So you're putting
Mhm.
175,000 down. So you're actually only financing up 525,000, correct?
Correct.
Okay, keep going.
525. Yeah. hmm and so on that 525, we will do a fixed rate for the first 5 years. So typical rates right now, just to give you a ballpark, we're looking at about 7.5%.
Okay.
So about 7.50. And our amortization, the maximum we can do is a 20-year
Okay.
on those. And every bank is different, but that's our our rates right now.
So you want to figure out what your monthly pay is. So this is probably not too bad because with monthly pay of 429, and let me do it like this. Make it. I know this is kind of confusing how I wrote it out, but your your monthly income and your monthly debt service is going to have a cash flow. Y'all are really seeing my my Google skills, my spreadsheet skills. There we go. There's my cash flow, $2,937. So that's income. Does that make sense? So that's your cash flow based on your down payment of, what do we say, $175,000. Okay, so let's talk about DSCR. So does that make sense how we got this cash flow number? So monthly debt service, monthly income. So my monthly income is 7,000. My debt service is 4,000. I have cash flow close to 3,000. Any questions?
So that didn't have anything to do with investment, right? That's totally just month cash flow
Yeah,
from
that's the
income.
monthly cash flow.
Okay.
So if you're thinking that your down payment, I could be more sophisticated for this with this, but if my down payment is this and my return is 29, 37, 31, which really you're looking at annual return 29, 37, 31 times 12. It's really 35,000. 35,000. So 35,000 divided by 175, because you're really just investing 175,000. That's a return of 20%. That's a 20% return on the down payment. That's not including the fact that the property is naturally going to appreciate by 4% every year. So
So
when
your
you add,
return on your cash
yeah,
for the year is at 20 without appreciation.
correct. So that's my cash on cash return. That's another term. So just to review. So we got our NOI. So if you can't figure out NOI, this is all going to be gibberish. Cap rate, that's just a guide stick. At the end of the day, the cap rate doesn't really mean anything. It's just neither does gross rent multiplier. Gross rent multiplier is your rent times how many years to get your sales price. So my monthly income and then my monthly debt service is going to get my cash flow. So I got a cash flow. So in my annual cash flow, my annual return is 35,000. That's about a 20% return. I would say that's a good investment. This is going to be hard to buy that high. Your internal rate of return, we can talk about that on another day but ask me about when we'll probably do multifamily again because this is quite a bit to cover. But what I want to get to today is DSCR. When I first heard this, it made no sense to me. And then once I understood it, once I wrapped my head around it, it became a very simple concept. So do you want to talk about the
Mhm.
SCR? Because ultimately, on the mortgage side, this is what you're going to look at before you give the
Mhm.
final thumbs up or thumbs down, right?
Yeah, I want to say the biggest deal killer right now seen is the DSCR on the deals. And so essentially, what we do is we take the NOI
Hmm.
and we divide it by the debt service for the amount. And I'm sorry, I can't see the numbers. What I know the NOI on this is 86,000, and what
Yeah.
is the debt service on that 525,000?
So the debt service is a little bit better.
Yeah, yeah, yeah. I see it monthly. What is it annual? Or do we have it annually or no?
Annual debt service is 4229.36 times 12. It's 50,000.
Okay. So that's a 1.72. So all we did is did the 86,000 divided by what number did you give me again?
Yeah, 50,000.
50,000. Yep. And that gives me 1.72. So what we're looking at is a 1.25 or better. So this would cash flow very well for us in our book. Um, And so the reason for that again is just, for every dollar we let you borrow, we want to make sure that you're getting back $1.25 in income
Yeah.
to kind of simplify it. But yeah, essentially that's it. And so as Austin was saying, this is very true because I see it every day, is a lot of, the sellers haven't caught up with what's going on in the market or the real world. A lot of them are still trying to sell, at a higher price. And so it's not cash flow. It's not meeting that 1.25 service coverage. And
Yeah.
so the way to mitigate that is we ask clients to either bring more to the table, more down payment, to make it cash flow, or obviously negotiate the price down. And so that's and the other part about it that I have seen some folks trying to kind of work around this is maybe they'll get and I don't want to get too into the weeds here, but they may get a second lien on it, or do some seller
Hmm.
financing where the seller carries another portion of the note. That tends to get a little messy, if I'm being honest, just because
Okay.
there's, we always want to be in first lien position, and we do have to take that new debt into account. So the debt's still there, it's just with someone else. So that's just something that kind of, it's a little caveat there.
So just to recap, this DSCR, and I would have this conversation with the seller. I need to be 1.25, maybe 1.3. Higher the
Hmm.
better.
Hmm.
But if it's less than 1.25, you may not be able to obtain financing on it. So you're just taking that 50,000, you're dividing it by 86,000.
Vice versa, 86 divided by the
Oop,
50. So the
thank you.
NOI divided by the price.
And so I'm getting 1.72,
Hmm.
which is
Correct.
this would be a good deal. Anything
Absolutely.
above 1.25 is worth looking at.
Yep. And just a little hack that even I use here at the bank. I just downloaded this little thing called Easy Calculators, and it just,
Yeah.
and I think you probably have a few of those, but that's how I work up the numbers as far as what the debt service is going to be.
But those of us that like to write on the back of a napkin,
Right.
this is just back of the napkin. We do have tools and stuff that we can use, but
Right. Right. Hmm.
there's sometimes when we're going through a lot, we just you get faster and faster at calculating these things, but those tools are really good. For somebody
Hmm.
who's new to this, I would say number one, as we've been saying since the beginning, get in the habit of looking at deals as much as possible. Even if you don't know what you're looking at, if you find a deal that looks interesting, send it over to us. We'll take a look. And the important thing, one important thing that I think is worth mentioning, it's not always about like, is this a good deal? Is this a bad deal? The better question to probably ask is, what would make this deal good? Because most deals are not going to be that great, especially in this market. We're just not finding great deals, and that's just the nature of the market. But it's Magdiel's job and it's my job to educate and tell you this is what has to happen in order to make this deal work. So we got about 5 minutes left. Yeah, come off mute. If you have any other questions, would love to hear from you. I know this is kind of a lot. We'll definitely hit multifamily again. This will be posted to YouTube so you can come back and refer, and we will email notes from this meeting. So, but
And
what are
Austin,
your,
can
yes,
I
sir.
chime in? Just one last little uh, nugget here. I would leave everyone with is the one final piece of this that we look at the bank is we want to see experience. And so it doesn't mean that if you don't have experience, you can't get the property. But if someone it's their first time buying multifamily, we would typically ask for a management company to step in
Mhm.
and maybe help them kind of manage the leases and things like that. So again, this is only if it's a bigger property, right? If it's a 4 unit, 6 unit, may not be,
Yeah,
necessary, but just something to keep in mind as well.
yeah, yeah, definitely. And management, can be anywhere between like 8% and 12% of your gross is going to go to management. So a lot of times these properties don't have those management fees on on their income statement, and that needs to be
Mhm.
calculated. So, any other questions, thoughts, feedback?
Austin, he kind of hit on it there. That's what I was going to ask was, for the majority of people here, they're probably first time buyer on a multifamily like that.
Mm-hmm.
How much weight is given to experience? Um, and, if you have someone that's maybe going to do not necessarily an on-site manager, but,
Mm-hmm.
like some of the things we do where uh, we have network with someone who runs a property management company who'll do that, but not be on property.
Right. Yeah, and it's good to have all those connections in your corner too. Like you got to know,
Mhm.
we talked about that in one of the first episodes is just building your team, just having a list of like property managers, even for single family homes, it may be worth it. You do the math and you calculate the value of your time versus the cost of property management. For a lot of people, it's worth it just for the time savings on that as well. So, but to some people, it's not worth it. So it just depends. Thanks, Liv. Appreciate you being on the call, Rick. Grateful for you being on the call. Don't forget, we're doing our happy hour third Thursday in June, 4 to 7. We'd love to see everybody in person. Liv, I owe you a book, so you need to come at some point so I can give you that book. And then uh, check out at Austin from Houston 12 on YouTube. This video will be reposted, and appreciate everybody's support and hope everybody's learning something. Have a great, wonderful rest of the day. Magdiel, appreciate you being here, brother. Thanks so much, man.
Of course. Thank you, guys.
Y'all
Appreciate
have a
it.
good one.
Have a good
Bye.
one.